The transportation and logistics industry has its own set of challenges. In the hot seat, industry thought leaders take on M&A and what's driving the future of transportation and logistics. Are you ready for the hot seat?
Welcome to In the Hot Seat with the Tenney Group. I'm Spencer Tenney. It's good to be with you. Now, transportation stocks are on fire. What the heck is going on? With me in the hot seat today, I've got Lee Klaskow, Senior Analyst at Transportation and Logistics at Bloomberg Intelligence, and also the host of Talking Transport's podcast. Lee, welcome to the hot seat.
Thank you. It's the second best podcast after yours, of course.
No argument here. No argument. Well, hey, listen, I'm very excited. We got a lot of stuff going on right now. We're going to try to cover a lot of ground. But before we do that, why don't you just take 20, 30 seconds and give us a little context of some of the work that you're doing there at Bloomberg?
Sure. So I'm at Bloomberg Intelligence, like you mentioned. That's Bloomberg's research arm. We have over 500 analysts around the globe and strategists. I cover the transport markets, but we also have analysts that do strategy, credit, economics, all sorts of things that people are interested in. Our research goes across the Bloomberg terminal. I've been here at Bloomberg for about 15 years now. I'm an ex-sell-side analyst. I did that for 6 years on the street before coming here. And before that, I was involved in equity capital markets and some other fun stuff related to stocks. So that's my background in a hurry.
Yeah, in a hurry. Speaking of being in a hurry, you've been covering a lot of ground out there in the event circuit, either, London, there's Women in Trucking, there's a lot of different places that you've been in the last, call it 30, 60 days. What are some of the things that you're hearing out in the market? I can imagine it's a little different being, in the analyst seat, but then when you go out in the field, you hear different things. What are some of the themes that you're hearing as you come to some of these events? Even, I think Trimble was another one that you've been to here recently.
Yeah, and I really do enjoy going and speaking at these events because it's a really great place to do some channel checks, and the people that are there, it's just maybe different than the people that I talk to in the investment community day to day. Really, I guess would call it frustration. That's kind of where people are right now, just given the fact that, while we're almost at the end of the year, we were starting the year, people were pretty optimistic that the, reduced regulations, lower taxes would be really good for, the business climate. But obviously that didn't really pan out due to tariffs. But there are some growing optimism, especially in the trucking market, that things are about to turn. I know people have said that numerous times over the last 3 years. I would say that the things that are different is actually the actions that the federal government are taking to make it, to enforce the rules that are already on the books and be a little more stricter with the non-domicile CDLs, which, could impact around 200,000 drivers out there. And that could have a profound impact on capacity, which obviously has been, there's been too much of it relative to the demand out there.
Yeah, I mean, let's unpack that a little bit, because I think there's a couple of different train of thoughts. Obviously, there's the capacity issue, and there's also the demand function. Some people might say that, hey, we're still having issues because even some, economists within this industry might say that without more demand, it's pretty hard to move the needle. What say you?
I think you need both. So I think you need some decent demand, and obviously you need capacity to come out of the market. I mentioned 200,000 truckers. I mean, they're not just coming out of the market tomorrow. That's going to be like a slow bleed out. And then you have the English proficiency requirements. I mean, that's going to also take time because you have the state officials or police officers have to pull those people over and figure out, can they speak English or not? So that's gonna take a considerable amount of time to play out. The consumer appears to be pretty resilient, but when you kind of peel the onion, it really does seem like a K-shaped recovery where one end of the barbell is doing very well, and unfortunately the bottom end of the barbell are not doing as well. One of the dollar stores, I think it was Dollar General, they came out with some really optimistic revenue expectations, more so than what was going on in consensus, and that's just showing that people are consumers are probably trading down, which is good for the Walmarts, Targets, and the dollar stores.
Understood. Well, speaking of which, in terms of a little bit of the outlook, you were cited in an article in Transport Topics a couple days ago And I'll read you this title. It says Dow's transportation average blazes 9-day winning streak. Equity traders are bullish on trucking and other freight sectors. So tell our audience what's happening here and why is it significant?
Well, the industry has just been beaten down for so long just because there's been a freight recession. We're in a third year, and that's not been great for demand. And then you have this so much capacity that's in the market. I'm sure you've had plenty of guests come on scratching their head on why it's been taking so long for some of this capacity to come out, especially where freight rates are, and that a lot of truckers are barely making a living, and some are just maybe able to pay down their truck payments and not really looking at their business more for cash flow as opposed to making an economic profit. But so I think that people are just getting a little excited about what's going on with like I mentioned earlier, the potential for all this capacity to come out. Consumer confidence indexes aren't doing great. The ISM is not doing great. GDP expectations are all sub 2%. So, we're not talking about like robust demand here. I think people are just getting a little excited about the supply picture, which, as you probably, which you do know that, once the spot rate firms up, that means the contractual rate in the truckload market firms up, and then that's good for the LTL market. That's good for the intermodal market. So it's kind of like a ripple effect within the freight markets if you're a capacity provider, a positive one.
Yeah, I think one of the things in this article, what it talks about is just like the performance is kind of outperforming the rest of the market, which doesn't happen a lot. And one of the fellow contributors was quoted saying when both, talking about the broader market and the transportation stocks, when they both march higher together, it means economic reality is aligning with market optimism. How do you respond to that?
Yeah, so what I would say to that is, while the last couple weeks have been good for the transportation space, if you look, year to date, the markets, the sub markets have pretty much vastly underperformed the S&P 500, which is up around like 16% this year.
Right.
But so if you look year to date, the truckload LTL and the railroad space and the parcel providers have all underperformed the broader market. We've just seen a really beaten down industry catch a break. So I think it's, I wouldn't get overly excited that like, oh, this is going to be a start of a bull market. And by the way, at Bloomberg Intelligence, we don't do buy, hold, sell recommendations. So just wanted to make sure my compliance people heard me say that. And so like, this is probably going to provide, a long standing upside. You have to see, the anecdotal evidence of, more bankruptcies in the truckload market and what the federal government is doing to kind of show up in the rates. And we saw rates, go up this week in the spot market. They went up 2 weeks ago and they kind of had a little pause during the Thanksgiving week. So, it's an interesting time. I wouldn't call, anything that we've seen so far as a real trend yet, but, it is incrementally positive.
So for our audience benefit, 9 days of upward trend or upward movement is not a trend. Is that?
Yeah, no, I mean, I wouldn't put it that way, and as I'm talking to you, I'm pulling up a chart right now that from the Bloomberg terminal, and so like our class one rail index is up 9%, and so that's a vast underperformance of the S&P. Like I said, that was up 16%, and you have the truckload market that's down 16%, the LTL space that's down 14%. So I guess people get overly excited and giddy
Yeah.
When stocks start moving. But there's a lot of things that these industries and these companies have to overcome to start showing earnings growth. And I think consensus expectations for 2026 are for earnings growth to return to the truckload market and the LTL market. But that's and I would note the sell side tends to be overly optimistic. But I think there are some early indications that that scenario can play out, and really the demand side, in our view, is going to be the thing that is going to dictate whether or not that these companies can exceed expectations.
Well, we live in a world of sensationalism, and I think part of the hook in that part of that article talks about how the a handful of stocks have outperformed Nvidia in the last 30 days. I was like, well, that's not really a whole lot of context to work with in terms of what's actually happening. But either way, it sells. So
Yeah.
but it does transition to my next thing, which is we talk about headlines. What are some like we see headlines but what do you see as an analyst ahead in perhaps 2026 or even in the next couple of years? What are you seeing that maybe we're not seeing in headlines or in other media outlets?
Yeah, so I cover all modes of transportation as it relates to freight. So I care about the movement of stuff, not so much the movement of people. Like I do like some people, but I don't care too much about the movement of people. When it comes to the freight markets, and we cover, like I said, all modes. So it's domestic and it's international. I think what's going on in the rail industry with the merger between Union Pacific and Norfolk Southern, to me is very interesting because, there's a lot of optimism that this deal will get done, whether it's because of, the STB might get another person added that's going to be nominated by the Trump administration. News reports of Trump meeting with the CEO of Union Pacific, and the fact that Union Pacific donated some money for the new ballroom, might indicate that maybe a more favorable look at it, even though the STB is supposed to be independent. We might be a little naive thinking that they're going to remain independent and that the regulatory hurdle is pretty high. We were out there with a 45% probability that the deal gets done, and I would tell you that's well below consensus. We'll see how that plays out. But I would say that we are getting incrementally less pessimistic as time goes on. But really time will tell. And I think this year is going, or as you say, next year is going to be very interesting with, there's going to be two huge PR war rooms that are going to be putting out stuff on a weekly, daily basis on, why this deal or why this deal should not or should get done.
I think it's fascinating, especially for someone in your position to be evaluating the potential scenarios of how you think about the industry following an $85 billion merger. I mean, how do you even think about that from an outlook standpoint? On one path, it, involves the merger of which completely changes, downstream logistics of everything. And then if it doesn't happen, I mean, it's a completely different future state. So how do you, as you think about the future, how do you plan for that? How do you advise? Let's kind of walk us through your thought process on that.
Right. So when you just look at the deal for its face value, it obviously makes sense. But there are rules in place where they say it has to be in the public interest and it has to enhance competition. Some could argue that some of that enhancement of competition has happened already because some of the Class 1 peers like CSX and Burlington Northern have already announced collaborative services to kind of try to buttress the impact from a merger. And it's interesting to note because of the merger rules, Union Pacific and Norfolk Southern really can't do anything significant together. So BN and CSX kind of have first mover advantage, if you will. So that's, somewhat of an interesting thing. But if the deal does get regulatory approval, we don't think it stops there. It would obviously, force another merger, and that could be a Burlington Northern CSX. It could be a Burlington Northern or Canadian Pacific. And those two combinations are compelling for very different reasons. Obviously connecting Canada, the U.S. and Mexico, and then having that, east-west connection would be a pretty interesting a network, and I'm speaking about Burlington Northern CP. But only time will tell if, like I said, if the deal actually transpires. But if it does happen, we think that there's going to be further consolidation. I think that's kind of like an automatic.
Well, one of the things I remember probably a month ago, there was an article in Trains magazine, and CEO of Union Pacific commented that they felt that they had up to 700 $750 billion of potential synergies that they could potentially forfeit as part of accommodating whatever the STP needs to get comfortable with enhancing competition requirement to pass this deal, which is just kind of a remarkable thing to say or contemplate for that matter. But what other levers do you think that the parties involved, what levers did they have available to help get this thing through, to appease those that need to sign off on this merger?
I really think it's going to be, I mean, I guess they can offer the concessions, but the real concessions are going to be made by the STB. And they're going to say, this is, if you wanted to get it done, this is what you're going to have to do, whether it's selling off a piece of a network, whether it's saying that, your competitors can go on this part of your network whenever they want to, or with some sort of an agreement. So there's a lot of things that they could do, or, you have to have a certain amount of, labor union employees, or like it could be a lot of stuff. We don't see a merger between UP and NS ending and a lot of union jobs going away because you still need those people. And I think the rail industry really learned their lesson during the pandemic of like overly furloughing folks, and then when demand kind of comes back, they were kind of caught very flat-footed, and I think that they also, some of the concessions could be service related. They might have to reach some sort of service benchmark for a certain amount of time, that is going to be scrutinized by the STB. So I think it's going to be very interesting to see how it plays out. But like I mentioned earlier, that hurdle to prove that it enhances competition and it's in the public's best interest is a very high hurdle. And you have lots of folks against the deal, and you have probably a lot of folks on the other side that are for the deal. So it's going to be an interesting year.
No doubt about that. Outside of rail, what other story developments have your attention going into this next year?
I think the LTL industry is pretty interesting. It's getting more and more consolidated, whether if you have like a company like Saia getting into new markets, or you have Knight Swift, trying to build out its national network. And, it looks like it has room if they do another acquisition. This could probably be in the Northeast. That probably makes the most sense. And then, you have a lot of company specific initiatives, whether it's, XPO, taking more stuff, more of their line haul stuff in-house versus outsourcing that, or ArcBest going after different customers than they traditionally has. I think there's a very interesting story there, and against this backdrop of really not great tonnage, you've seen tonnage declines for quite some time. They've been able to hold pricing, and that's kind of been one of our calls within the LTL space, that some folks were pretty pessimistic about pricing, thinking that they wouldn't hold the discipline. But for those that have been following the space for a while, they remember that when FedEx and Conway, which is now XPO, tried to win share away from Yellow in, I think it was 2003, 2005, something around that time, try to push it into bankruptcy. It didn't work. And those companies, it took years to get their yields back to where they needed to be to make the ROI that they needed to reinvest in their network. So I think that, the industry remembers that, and they know not to try to win share through aggressive pricing. But it will be interesting to see, what the largest player does, FedEx Freight, once that's spun out of FedEx Corp, sometime next year. So that's going to be interesting to see how they act as a standalone LTL player.
Oh, very interesting. So let me read something to you. This is from Jason Miller, professor at Michigan State. Are you familiar with him?
He's got a great mustache.
He does have a pretty fancy mustache.
Yeah.
So he put some pretty
I read his stuff all the time.
Spicy opinions out there. So he has a take on the 2026 market outlook, and let me read this, and then we'll get your comment here.
Okay.
So he says, I'm generally expecting freight demand growth to be muted over the next 6 months, as I perceive several headwinds moving into 2026, including, number one, manufacturers' new orders remain depressed based on ISM and FedBank surveys that capture what economists term the extensive margin of new orders, which has historically been a very good predictor of trucking market cycles. Number two, there's a limited reason to expect single-family housing activity to aggressively rebound over the next several months, given the slow pace of hiring and owners increasing delisting homes. 3, economic policy uncertainty due mostly to trade policies isn't going away in 2026. And then finally, number 4, we will start to see the more complete impact of tariffs, most of which only started hitting the full force within the last few months next year. And unlike this year, front loading won't be possible. So how do you respond to that?
I think everything he's saying is pretty rational. I don't think that's it. The ISM has been in contraction territory 35 of the last 37 months, and that is a kind of a precursor for LTL demand and truckload demand. So that's not in a great place. Industrial production expectations are expected to be sub 2% again. So that's not a great thing for the manufacturing sector. The impact from tariffs on inflation, we've been very critical of what that's going to do and how inflationary that is. And that's going to obviously affect, how much customers not spend, but how much stuff they buy. Because like I said earlier, I care about the movement of stuff. $100 doesn't buy as much stuff as it did last year. And, there's a lot of blame to go around on what caused all this inflation, but tariffs are certainly accelerating or adding to that inflation. And then, you mentioned the pull forward effect. The pull forward effect is going to provide some really tough comparisons in the first half. Analysts on the sell side and I, and folks like myself, we like to say a lot of the time, like, growth this might be second half weighted, but I think that's going to happen in 2026 just because of all these headwinds. And we've seen, rates are expected to get cut again. It's really not moving mortgage rates and as quickly lower as you are seeing with the Fed funds rate. So, there's a lot of headwinds facing the demand side. And that's why, when I was saying earlier, the fact that the supply in the spot market could come out, that is obviously going to be very positive. That coupled with, we'll call it tepid, low single digit growth, could actually create a much stronger market than what we've seen in 2025. And I'm not saying that like it's going to be like, oh, we're going to be going, it's going to be like truckload rates are going to $7 a mile. They're just, they could just move maybe a little better than low single digits, for next year.
I think most people that are either economists or want to be economists or whatever, you look at the Trump's tax policies. That's generally going to be friendly for economic growth. And then you look at the foreign investment coming to the United States. I don't know what the total is right now, depending on who you're talking to. 20, $30 trillion. I don't know, maybe more. At what point does the American economy begin to feel some of that fuel? Because it doesn't feel like we're feeling anything right now, but it certainly feels like it's a framework for economic growth. Well, so what did you say? Like, when are we going to start feeling that?
Yeah, but you have to add the uncertainty, and so people really aren't making those investments. They're saying that we're going to make those investments, but they're not actually putting the money into the ground yet. Industrial development is actually slowed. We talk to people that are involved in that on the real estate side, and some anecdotal channel checks indicate that it's a wait and see approach, because tariffs today might be gone tomorrow, and it could change the competitiveness of spending billions of dollars to create a facility in the United States. Before all this, the tariffs were going on, Mexico made a lot of sense for manufacturing to move. We could decouple away from China and bring manufacture closer. But, with the U.S. CMA probably be renegotiated, we don't know what that's going to look like either. So there's a lot of unknowns. And I think that, just because you have maybe a more pro-business administration, the uncertainty that's created by some of the policies are superseding anything else.
No, noted. So let me transition. to your podcast. Now you've quickly cranked out over 100 episodes, which congratulations, by the way.
Thank you.
So tell me, what's been the most surprising, part of that experience that you've enjoyed?
I found 115 people that are willing to talk to me. I mean, to be perfectly honest, I started this not thinking that it would get the traction that it did, and I'm happy to see that it has. A lot of that's been organic. Honestly, the thing that I like most about it, I wouldn't call it surprising. It's just the interesting conversations that I get to have with folks. You were on the podcast at one time, and I thank you very much for that. But it's like, I get to talk to, folks like you. I get to talk to CEOs of large Fortune 500 companies. I get to talk to people that are working on some of these new technologies that are going to impact, supply chains and logistics. And who knows, they might be successful or they might flame out. You just don't know. And it's just really, really interesting. I guess the whole spectrum of folks that I'm able to talk to. And, like I mentioned, I cover all modes. So, one day I could be talking to somebody, a CEO of a dry bulk company based in Copenhagen, and then the next day, talking to, a trucker, a CEO of a trucking company that owns 50 trucks. And I think that every one of those conversations can be equally insightful just because of, their own personal experiences, and what they bring to the conversation. So it's really, to me, it's just about talking with different folks and learning more. And that's kind of, one of the things that I love about doing what I do as an analyst to my day job, is telling a story and kind of giving an opinion through analysis about how we see the world. And when you hear other people able to do that as well with their own expertise, it makes my job better.
Well said, sir. When we were, our worlds are not that dissimilar in the M&A world. When you start talking about, just investment and sentiment, I've literally said the same thing on other panels and things, and people ask me like, well, what do we need? And I was like, we don't even need, perfect economic conditions. We just need a stable environment. People will transact, and as long as it's stable. And I think that's a lot of wisdom of what you said. So the sooner that we can get some stability in the marketplace and at least a runway where there seems like there's going to be as little disruption as possible, which this is transportation. We're never not going to not have disruption, but it's such an important part of unlocking a lot of really interesting M&A activity. So I appreciate the comment. We got time for about one more. I think we'll do a little bit of a wild card question here, Lee. So what is I'm curious if you went back and you were to invest 20 years in an industry that was not freight related, let's just start over at college. What is an industry that just fascinates you?
Okay. Well, I have to do my disclaimer. We don't do buy, hold, sell recommendations. So this is a theoretical exercise. And I won't name companies. What would I invest in? Yeah, it's got to be technology. I mean, this has to be technology. I kick myself all the time that I should have known Apple was going to be a huge company, or I knew some of these large these mega seven companies, the strength that they have. I think it really just boils down to technology because look what you and I are doing right now. I mean, we're on a very a more sophisticated Zoom call that provides fantastic audio, and it's it doesn't really cost much to do. It's phenomenal what technology enables us to do, whether it's with our cell phones or your cars, some of the technology that's there. So I would just say technology broadly. I don't know if that was a good answer or
well, no disagreement here. Hey, listen, I'm so appreciative of your candor and your terrific insights. You're a great asset to our industry. I really thank you for being in the hot seat, sir. That's going to do it for us today. We will see you next time.